Right now, behind the scenes of this week's wild trading volume, a fundamental shift is happening that could catch 99% of retail traders off guard. If you think the Nasdaq's recent volatility is just a healthy pullback, you're missing the real story.
In the U.S., the AI shock is leading to a boom in capital expenditures.
Is it inflationary?
Well, in the near term, we can observe it on the demand side, but it's up to the central bank to decide whether it's inflationary.
That's why I'm asking.
The Federal Reserve just dropped a bombshell concept that is causing massive institutional rotation across both the S&P 500 and tech indices, and that's AI inflation. For months, Wall Street told you that artificial intelligence would streamline the global economy, crush operational costs, and boost margins. But the latest economic telemetry is showing the exact opposite. The sheer volume of corporate cash flooding into infrastructure, energy grids, and data centers is creating an artificial bottleneck. This is driving raw material costs up and keeping structural inflation stubbornly high. So to understand why your portfolio is swinging like a pendulum over the past couple weeks, we have to look at the cracks that are forming outside just the microchip plays. It's not just about tech anymore. The AI narrative is officially bleeding into the broader economy. For example, look at what just happened with Starbucks.
What do you guys want?
Let me get a fratte motete, and then let me get a Trenta pinkity drinkity.
Drinkity pinkity dinky and a fratte mate.
What the hell?
When a consumer giant issues software-related warnings and soft-forward guidance, it hits the market like a lightning bolt. This proves that the massive multi-billion-dollar tech integration companies have been bragging about isn't producing immediate retail miracles. Instead, it's exposing operational vulnerabilities. Now, at the exact same time, the semiconductor landscape is shifting beneath our feet. The initial wave of buy everything AI related is officially dead. Big hedge funds are realizing that the cost of building out these 50 megawatt data centers is skyrocketing due to hyper-localized supply constraints. The question isn't, is AI the future? It's whether the stock market has priced in the next 3 years of growth today, leaving zero margin for error. Now, this has set off a fierce ideological war across all institutional trading desks. So let's take a look at both sides, because both sides have very compelling arguments. The big money bulls are looking at this volatility as an absolute gift and the perfect entry point. Their thesis is simple: don't fight structural momentum. Legendary macro managers like David Tepper are positioning heavily for what lies ahead, recognizing that capital expenditure cycles of this magnitude do not just disappear overnight. The bulls argue that short-term panic over sticky inflation is not looking at the bigger picture. Once these next-generation data centers go live, the deflationary productivity gains will unleash an economic boom that justifies every single cent of the premium valuations. To the bulls, any software glitch or minor cut in guidance is just noise. The structural trend is your friend, and stepping in front of a secular tech freight train is a great way to destroy your capital. But now let's take a look at the bears' perspective, because their argument is starting to look terrifyingly logical. Prominent short sellers and risk managers are aggressively raising their index shorts on the SPY and QQQ. The bear thesis is built on simple math, multiple compression, and historical precedent. They point out that the massive divergence between index heavyweights and the rest of the market is entirely unsustainable. If the Fed refuses to cut interest rates because data center construction is keeping inflation high, then the rest of the economy, which includes 490 companies in the S&P 500, will suffocate under the weight of high borrowing costs. The bears warn that we're watching a capital expenditure bubble being built in real time, where companies are buying monthly puts because tech valuations are completely decoupled from consumer reality. Now, when the music stops, the down cycle won't be a calm, orderly retreat. It's going to be a violent correction. So the lines have been clearly drawn in the sand. On one side, you have the bulls gambling that the generational tech innovation will always outrun macro gravity. On the other side, you have the bears betting that monetary reality and compressed margins are about to break the market's back. So as you watch the S&P 500 and Nasdaq tick violently up and down, you have to decide if you're gonna pick a side or sit out and wait. Because if the very technology that's supposed to save corporate margins is the exact thing keeping interest rates high and suffocating the broader consumer economy, are you buying the AI growth premium at any price, or are you preparing your portfolio for the macro correction that history says is inevitable?